Morning, everyone. Welcome back to our morning kappa at 8. I'm Joseph here. So, looking at the last Friday price actions, I can see that Hang Seng Index underwent a very strong selling pressure, right? And at this juncture, right, the bullish setup remains bullish. That was a bullish breakout last week, and we have raised our stop loss to 500 point level. At this juncture, the 20 days moving average, the 20 days moving average is acting as a downside support right now. And market is showing concern since that recently we do see that the oil price is moving higher. And this morning, Monday, I can see that the oil price have a gap up and heading towards the 85 level. So if that's a bullish breakout on 85, I think the market would be concerned on the higher oil price that may induce more inflations. Now, at the Hong Kong market right now, we'll be looking at Petrol China this morning, eyeing to break out from 9 Hong Kong dollar 60 cents, and the R1 is 10 Hong Kong dollar followed by 10.30, and that support is 9 Hong Kong dollar 20 cents. And then on we have the power assets which climb above 59 Hong Kong dollar. Resistance 1 is at 62 and followed by resistance 2 at 65. Down support is 56, right? And looking at the gold, right? Gold price has been moving downwards steadily, and last week you have breached the 4,000 level. And although the Friday sessions it do have a rebound, but this morning, right, we do see that the gold have a gap down, and right now lingering just around 4,000 level. So on the upside, stop loss remains unchanged at 4,004, and on the downside, the gold may hit towards 3,850 and followed by 3,007. So based on the technical setup, the gold is showing a bearish setup right now. Now, as for the Friday sessions, we also see that the regional peer Nikkei 225 have a very strong corrections. You have breached the weekly support level, and right now the Nikkei has fallen below the 20 and 50 days moving average. So look at the Nikkei 225, right? They have been trading on a lower high and lower low for the past 2 weeks, and they also breached the 64 800 point level. So can see that the strength of corrections is quite strong. Um, Likelihood the Nikkei will be pull back towards a 60,000 point level. So at this juncture, now we do see that 60,000 is a very strong support level for the Nikkei, and the level was being tested during the May this year, 2 months ago. So if the Nikkei breaks below the 60,000 point level, then on we shall see a very strong corrections afterwards. But at this juncture, right, we still keep a bullish bias with the 60,000 point, a strong major support for Nikkei 225. Now, meanwhile, on the Friday sessions, you do see that in tandem with the higher oil price, right, and also the weakness on the Nikkei 225, both have caused a negative sentiment in the market, right? So on Friday, the SPX have gapped down, and right now trades are below the 20 and 50 days moving average. So you can see that the corrections are do in play right now, but for the SPX, we do see that the major support will be the recent low somewhere at the May, which is the 7150 point level. Now, meanwhile, look at the S&P over the week, right? I can see that most of the stocks have corrections that lead by the memory counters. Now, only the Apple have been bucking the trend, went up by 6%, right? And looking at the overall price actions, we do see that there's a technical breakout on the Valero Energy at the US market, stock code VLO. So Valero have break past 300 US dollars, heading towards 325 and followed by 350, right? And down support is at 275. Now, apart from Valero Energy, let's look at another petroleum related counter, which is the Occidental Petroleum, stock code OXY in the US market. So OXY is a pending breakout on the 55 US dollar. So if breakout happen, it climbs to 58 and followed by 61. Thus the support is 52. Right. So we have the OXY, Occidental Petroleum, pending breakout, and then the Valero Energy breakout stocks in the US market. So let's move to the Malaysia market, right? Last week, FPM KLCI underwent a very strong upside movement. Right now, you can see that FPM KLCI have a climb above 1,007, heading towards 1,750. So based on the last week, right, the financials sector together with the plantation sectors, is the leaders in the market. Right. Meanwhile, consumer telecommunications and technology have corrections over the week, right? And for the FKLI, we do see that the FKI should test 1,760 and followed by 1,008. So on the downside, immediate support 1,007 and followed by the lowest support at 1,680. Right. To protect the downside risk, we have raised our stop loss point from 1,650 to 1,680. Right. Now, meanwhile, looking at the FCPO, right, it's consolidating sideways, eyeing to break past the 4,007 resistance. So if a breakout happen, the next higher resistance will be 4,009, and that support is 4,390 and followed by 4,250. So over the week, Malaysia market do have more positive price actions. I think the best perform counter so far over the week was Tanko, went up by 76%, followed by Nation Gate that went up 35% over the week. Now, meanwhile, we do see that VS also rebound from the recent low by 15% over the week. Now, generally, the sentiments is quite positive on the financial stocks, i.e. the public bank, right? So looking at the plantations related counter, Johor Plantations Group, JPG, eyeing to break out from the 2 ringgit resistance. So if breakout happen, the JPG will be testing next resistance at 2 ringgit 10 cents and followed by 2 ringgit and 20 cents. Downside support is 1 ringgit and 90 cents. Then on we have one property counter, SB Setia, eyeing to stage a counter trend rebound. So last week, you have climbed above the 94 resistance. Right now, the next resistance will be 1 ringgit mark and followed by 1 ringgit and 5 cents. Downside support is 90 cents. So we have pending breakout, the JPG group, and followed by the breakout stock SP Setia. So I'll stop here and pass on to Yee Sian on the weekly Rasa Mengguan report. Thank you.
Thanks, Joseph. Good morning, everyone. Please let me to share my screen. Okay. So as what we highlighted in our last week rasa report, so we do see that as indicated by our RHB risk sentiment index, we are seeing that investors remain risk on despite the escalating Middle East tension. So our RHB risk sentiment index has moved above 1 threshold, supporting a tactical overweight stance on developed market and ASEAN equities. That said, risks are re-escalating towards our worst case sea of rate scenario with reports of renewed exchanges of strikes involving US and Iran. So should tension persist, risk appetite could actually soften further. So however, based on the commodity prices itself, there's still some spaces when you compare to our worst case scenario of around $140 per barrel. So where at that oil price level, we are seeing that there's a significant downside to the global economy due to the pressures on the inflation and also impact on manufacturing and trade activities. As per today morning, the Brent oil price increased to around $90 per barrel. So and then note that currently poly markets polls are less optimistic now. So where only about 50% of the polls do expect a full Hormuz opening by end of this year. So on the market end, so we do see that sell-off in AI related indices, so including the Kospi and also other technology-heavy benchmarks could deepen amid concerns that AI-related earnings may not justify the current valuations. Our analyst continues to point to pockets of price exuberance within the AI ecosystem, where a medium-term valuation reset could generate negative spillover across the broader E&E supply chain as well. So for the US end, so we still maintain our view that Fed fund rates will remain unchanged throughout year end 2026. So softer US inflation has also led the markets to pay expectation to just one rate cut by the end of this year. So down from around 1.6 cuts price in June. So lower energy prices have driven a recent disinflation, suggesting much of the earlier inflation surge was actually energy related. Combined with softer PPI and also CPI readings, this should also translate to a more benign PC inflation when released on 30th of June as well. So on China end, China has released the second quarter GDP as per last week. So weaker than expected GDP growth at around 4.3%. So to reinforce our cautious stance on the China economy this year. While the recent rebound in the MSCI China appears to be largely technical and also driven by a short covering. So for China, we still maintain our full year GDP growth forecast at 4.5%, despite China recording 4.3% growth in the second quarter. So for the second quarter, so the slower than expected growth compared to market consensus of 4.5% is actually driven by a slower growth in secondary industry, which comprise of manufacturing, mining, construction, and also utilities. So in our view, part of the slowdown actually reflects the policymakers' efforts to curb the excessive AI-driven market exuberance. However, with the domestic demand, it still remain soft. Further policy stimulus may be needed later in this year to actually support the growth momentum in China. So on Malaysia end, following the last week release of the second quarter GDP, where the advanced GDP is also stronger than expected at 5.8%, compared to our in-house and consensus forecast of 5.2%. So combined with the first quarter GDP growth at 5.4%, this also translates into the first half GDP growth of 5.6%, which is also surpassing our in-house forecast of 5.3% growth for the first half. So following the stronger than expected GDP growth, we have revised our 2026 GDP growth projection to 5.4% compared to our previous projection of 4.7%. So this also reflects four key developments, so including stronger than expected GDP growth at 5.6%, and our auto-regression and leading economic index model is also suggesting to a sustained growth momentum, although it's slightly softer than the first half growth of around 5 to 5.2% range in the second half. And thirdly, we are seeing that there's a stronger than expected export performance year to date, with the momentum is expected to persist through the rest of the year. And lastly, the continued resilience of domestic demand, which has continued to support the economic momentum in the second half of this year. So as what we see in the second quarter GDP print, we do see that the stronger than expected GDP outcome was driven by broad-based growth across the sectors, especially with the manufacturing sector and also mining. Manufacturing sector actually expanded by 7.5%, which is also higher than the historical average. And also mining has surged by 10.2%, so mainly driven by the natural gas output for the mining sector as well. So looking ahead, we're still seeing that Malaysia growth outlook remains supported by broad-based sectorial drivers, with manufacturing sector underpinned by a sustained global E&E demand, robust domestic activity, while services sector is underpinned by firm retail and wholesale performance, and also seeing that sustained growth in the ICT subsectors as well moving ahead. So similarly, on the same day, we're also seeing that there's a release of the June CPI data, which came in at around 1.9%, which is slightly slower than May's print of 2% and lower than our in-house projection of 2.1% and Bloomberg consensus estimates of 2%. We're also seeing that in the June itself, core CPI inflation has inched lower to 1.9% compared to May's print of 2%. So for the rest of the year, average 2026, we still maintain the headline inflation forecast at 2.1%, which is the upside when you compare to year-to-date inflation of 1.7%. So the reason is because firstly, we are seeing that the recent data to indicate that there's a broad-based increase in the producer prices across the major sectors, suggesting that upstream cost pressure are gradually building. We remain watchful of the potential pass-through of the PPI upsides to the consumer prices in later part of the year. At the same time, we also stay vigilant to evolving geopolitical developments and also their potential impact on the global oil supply and commodity prices, especially following the recent increase in the Brent crude oil prices. So looking ahead, we are seeing that inflation trajectory in near and medium term will be driven by, firstly, fluctuation in global commodity prices, especially crude oil prices. Secondly, changes in domestic policies, and lastly, potential upsides from food inflation. So following the El Nino related concerns and the upside risk on the food inflation. That's all from me. I'll pass the stage to the next presenter. Thank you.
Thank you, Yee Sian. So I have a results preview on IHH Healthcare today. We are still neutral on the stock, 9 ringgit 30 cents target price from 9 ringgit 60 cents previously. This represents a 9% upside. So in terms of second quarter 26 results, the indicated release date for this is at 27th of August. We do forecast core profit of 482 million for second quarter. This is assuming 24% tax rate and a minority interest similar to first quarter of 26, which is at 32% of PAT. This number represents 15% year-on-year growth and 5% Q-on-Q growth, which if if you were to lump the first half numbers up, we do think that this will be broadly in line with expectations. With core profit, first half core profit at 47% of our full year estimates. On a constant currency basis, we do see revenue and EBITDA growth of 17%, 23% year-on-year. This will continue to be supported by margin expansion in Malaysia and Acibadem due to higher bed occupancy rate following the first quarter 26 seasonal weakness, as well as operational efficiency gains in India. In terms of full year numbers, we did adjust our numbers marginally. So 2026 is lower by 1%, 27 and 28 is +1 and +2%. The bulk of the 2026 earnings reduction actually comes from Singapore, where we cut 2026 revenue intensity growth to 2% from 5% previously, and inpatient admission growth to -4% from 2% previously. This is to reflect the number one, the structural shift in patient volumes towards public hospitals, and number two, probably the slower recovery in medical tourism arrivals. We understand that management is making concerted efforts to plug these leakages through initiatives such as expanding package healthcare offerings and also diversifying medical tourism sources beyond Indonesia. But we do think that these measures require time to gain traction. Meanwhile, Malaysia is well positioned to capture part of these patient leakages, given its more competitive pricing proposition. And accordingly, we did raise our Malaysia EBITDA margin assumption by 1 percentage point to 26 to 26.2% for 2026 to 2028, which is in line with management's 25 to 26% guidance. Upside to our valuations could come from either earlier than expected stabilization of the Singapore business and probably stronger earnings from Turkey. While for Turkey, we note that forecasting these numbers remains challenging under MFRS 129, as it is increasingly becoming difficult to distinguish underlying organic growth from hyperinflation adjustments. We did lift Acibadem's 2026 to 2028 earnings by 13%, 18%, 24%. But even after this revision, our Turkey forecast remains below earnings run rate implied in first quarter 26, suggesting that our assumptions remain conservative. So all in, for second quarter 26 results, we do expect it to be broadly in line with stronger growth coming from Malaysia and Acibadem unit, offsetting the weakness in Singapore. In terms of share price movement, we do believe that the recent share price retracement largely reflects the risk of slower than expected recovery in Singapore. Should the share price weaken further, we do recommend investors to gradually accumulate on weakness. So again, still neutral on the stock, 9.30 target price. I believe that's all we have for you today. See you again tomorrow at Morning Kappa.